Analyzing the market is the dumbest thing you can do as a trader. And I don't just mean bad analysis or wrong analysis. I mean doing any analysis at all. From the moment you open your chart, doing your pre-market analysis, then analyzing the market while it's open, then looking back on it later, all of it is completely unnecessary. It's countless hours every day that are wasted, and not just wasted, but actually setting you back. So now you might be thinking, how does that make any sense? And what the hell am I supposed to do then? Well, here's the thing. Despite popular belief, trading profitably requires minimal time and effort. Actually, the more time you spend in the market and the more effort you put in, the less likely you are to end up profitable. And this should be a good thing, but it upsets some people, believe it or not. They're chained to the belief that success requires enormous amounts of time and effort. That may be true in other fields, but trading is a different animal entirely. Hard work gets you nowhere. It's 100% about working smarter. And that starts with doing what actually works, not what you think you should be doing. So in this video, I'm going to show you exactly why you shouldn't be doing any analysis and what to do instead for your account to finally take off. Everyone tells you that trading is an extremely difficult full-time job, that you need to wake up a few hours before the market opens, do your pre-market analysis, check the news, check your setups, then be on your chart as soon as the market opens. From there, stay on your chart until you find a setup, then execute that setup, then do your journaling, then do some more analysis to prepare for the next day. This takes up hours of your time every day and all of your mental energy. It's basically a full-time job, except with 10 times the stress and without the guaranteed pay. Not exactly a dream. And we've been told that this is what's necessary to build a successful trading career. That we need to put in the hours, put in the work, and we'll make it to the other side. But if you've been trading for any amount of time, you know that's complete nonsense. There's a point where doing too much will be harmful. It's not as simple as more screen time and more analysis equals more progress. It's a nice little routine, but it's mostly useless. The vast majority of what you think you should be doing, and I mean like 95% of it, is unnecessary. It's a trap that traders fall into to feel productive because that's how we're wired to feel about difficult things. Trading can produce incredibly lucrative results, so people assume it must require insane effort. That's what we see with most traders' routines and analysis. It's very complicated, noisy, and has tons of fluff. And that's just uncertainty leaking onto the screen. And the solution to this is simple. Instead of doing what we think trading requires, we just do what it actually requires. Because we think that trading requires us to do long pre-market chart analysis, thinking about different scenarios, watching price continuously while the market is open, adjusting bias as new candles form, staying on top of the news, and reviewing charts repeatedly after the session. But what does successful trading actually require? Well, a profitable strategy requires you to have a defined edge, and the screen time to execute that edge. As long as you have an edge, which would be a combination of a win rate and a risk reward that's profitable, then you just need to execute that edge consistently to be profitable. And that doesn't mean you need to do all of this, or any of it really. Ask if it's even benefiting you. Because the problem with this way of thinking is that no matter how hard you try, you're still breaking the number one cardinal rule of trading, which is don't predict. As soon as you try predicting the market, you go down a rabbit hole that's very hard to come out of. You start trying to explain price instead of responding to it, and you start imagining outcomes instead of waiting for the right conditions. And the irony is that the whole reason we create strategies and systems in the first place is because we already know our instincts aren't reliable. So let's say a trader opens a chart like this. His job for the day is to find a profitable trade. That means he needs to get the price's direction right, which is already a 50-50 chance, and then get the magnitude of the move right as well. He can't end up taking profit too early or too late. When you put it like this, it's a daunting task, especially doing it day after day. And the trader might know certain setups and techniques and strategies. He might know his way around the market well. But the issue is the way he approaches it. He's treating trading like a puzzle that needs to be solved, instead of a process that needs to be followed. He's approaching the chart with the assumption that his job is to figure out what price is about to do. So every candle becomes information, every move needs an explanation, and every pause creates uncertainty. The more time he spends on the chart, the more he feels responsible for predicting the next move. The market doesn't care what you think should happen next. It only responds to participation at specific points, under specific conditions. When you approach trading as a prediction problem, you make the task exponentially harder than it needs to be. You turn a simple yes or no decision into a complex story. And no amount of additional analysis fixes that, because the problem isn't lack of information, it's the framework you're using to interact with the market. That's why traders can know the setups, understand the concepts, and still stay stuck. They have the wrong approach. A good example of this is when a trader opens a chart and says something like, "This looks bullish," or "I think we're about to break here." On the surface, it sounds reasonable, but notice what's actually happening. There's no action being taken. There's no condition being met. The trader isn't executing anything. He's just forming an opinion about what price might do next. Now, once that opinion exists, everything else becomes filtered through it. If price pulls back, it's just a pullback. If it stalls, it's consolidation before the move. If it drops a bit further, it's liquidity being swept. Every piece of price action now needs to be explained so the original analysis still makes sense. That's what analysis does. It commits you to a narrative before the market has actually done anything. And once you're committed to that narrative, you stop waiting for conditions and just start looking for evidence. And the trade ends up being based on interpretation instead of confirmation. A trader who doesn't analyze like this doesn't care whether price looks bullish or bearish. He doesn't care what the market might do. His only question is whether price has met the conditions that allow him to act. If it has, he executes. If it hasn't, he does nothing. That's the difference between analyzing the market and trading it. One is about calling moves. The other is about responding when the move is already underway. Now let me show you what that type of trader does instead. Instead of analyzing the market or spending all his time staring at the screen, this trader waits for something way more effective, which is flow. Flow removes the need to be right about the future. It turns trading into a simple yes or no decision. Is the market moving cleanly enough to participate or not? So it's like, instead of standing next to a river and trying to predict where the water will go, we just jump in when it's clearly flowing. When the current isn't there, he does nothing. No trade, no analysis, no screen time wasted. And when it is moving cleanly, the decision isn't complicated. So flow isn't something you predict or create. It's something you recognize. And once you build your process around recognizing flow instead of analyzing possibilities, trading stops being mentally exhausting and starts becoming more hands-off. Because when you really break it down, the market seems like it has infinite possibilities, but it really only has a few. It's either consolidating within market structure, or it's breaking market structure and expanding out of it. Most of the time, it's rotating within market structure. It's just chopping around unpredictably and not breaking any significant highs or lows. And that's exactly where most traders waste their time analyzing and forcing trades. But flow only shows up when price transitions from rotation into expansion. When structure starts breaking, direction becomes clear, and momentum begins to carry price forward. That's the only environment where trading actually makes sense. Inside rotation, there's nothing to predict and nothing to execute. Outside of it, the market is already doing the work for you. It becomes a very simple yes or no process where you ignore most of the market. This is what I call the LCE model. We mark supply and demand zones, which are levels that the market finds important. I'll link a video here that explains exactly how to find them, but this is where the market gravitates to. So once those levels are marked, all we need to do is wait for the price to break one of them, then trade to the next level. We don't even need to be on the chart. We can just set an alert, wait for the price to hit it, then enter a trade, and then get off the screen and set more alerts at the stop and the target. Then we just need to repeat this process for the next trade. If you want to see this work in the real market, I'll link some videos here where I backtest it in real time. So once you strip trading down to this level, you realize how much of what traders do every day is unnecessary. The constant analysis, the screen watching, the routines, none of that creates an edge. All it does is keep you busy. What actually matters is having a simple process, recognizing when flow is present, and executing when it is. That's the bare minimum, and it's more than enough. Most traders never make this shift. They stay stuck in analysis because it feels like they're working, even though it keeps them stuck in place. The traders who get consistent, are the ones who strip everything down to the bare minimum and execute the same process the same way, over and over again. So if this approach resonates with you and you want to master it, that's exactly what the LCE Accelerator is for. We run weekly group calls where we break down trades and keep your process clean. You'll also have a private one-on-one chat with me so you can get feedback or ask questions anytime. You'll get access to my supply and demand chart, the same one I use every day to trade this. And you'll be part of a private community of LCE traders who all trade the same system and hold each other accountable. So if you're interested, click the link below. And if this video helped you, be sure to like, subscribe, and turn on notifications. I'll see you in the next one.